Hey, this is Terry Hale, commercial trainer and wealth builder with another great segment of Wisdom for Wealth. I am very excited to share this segment, what I call non-conventional tactics. Now, this is all about commercial real estate investing. It works with every single property type through commercial. I'm talking multifamily, apartments, of course, self-storage facilities. We're talking about retail, warehouses, and even land. It works for all property types, assisted living, senior living, student housing, you name it. All right. So there's a difference between conventional and conventional wisdom is what I say. Folks that follow this, they're doing the business wrong, but yet they're still making a boatload of money. So that's how amazing commercial is. That's the vehicle to wealth. But the non-conventional wisdom, you can do it faster. You can do it even easier. You can do it with less stress and also less risk. So let's talk about the difference of conventional versus non-conventional so we're all on the same page here. Now, first and foremost, conventional means that you're going to purchase it the conventional way, either across the table from a bank and try to go for a bank loan on a purchase, or what you're going to do is create some type of a relationship and perform under these terms. And for that, you're still going to have to put down 20, 30, 50% down, whether you go to a hard money lender or you go to a bank, whatever institution you go to, right? Whatever lending institution. For that, you also have to personally sign. If you're taking notes, now's a great time. When you personally sign, that would be going for a recourse loan for a conventional. It's a recourse. That means that they want to see all your assets, your bank statements, your tax return, and then banks do something else as well because they want the lowest amount of risk when they loan money, okay? And we can't blame them, right? We can't blame them as long as they're doing it right and not those negative deferred amortization loans, right? So when they're going to loan, they want you to do something. If you have other assets, they want you to put those assets up for collateral. That's called cross-collateralization. So they want you to cross-collateralize other assets that you own to lower their risk. So if there was a default scenario, they could take your other property that you own. Pretty slick, right? Well, the non-conventional format is something that I've been teaching for the latter part of over 15 years. Now, this business of non-conventional wisdom has been practiced by the ultra wealthy. I mean, folks that have taken down properties and that exceed hundreds of millions, and even folks that are taking down properties that everyday folks can take down, which are regular 12-unit, 10-unit, even 5-unit apartments and 100-unit self-storage, like the one we just closed this last week. So very exciting format. Now let me explain exactly how this works. Non-conventional tactics work like this. First and foremost, we never give a personal guarantee. So we always go after non-recourse loans. When you create a note with a seller finance deal, the seller is going to finance you and they will carry the note. We do not give a personal guarantee, therefore there's no need for any credit. You don't ever have to put up your credit, all right? We get in with tactics. Instead of putting down 20, 30, 50%, we can justify, seriously justify why we would only put down, say, 5%, 10%, 15% maximum. And the reason is we're focused on the properties that are in need of some fix-up, light cosmetic, properties that are in great areas, and properties that have some vacancy. And that's the huge upside factor. I've always quoted the phrase, deep discounts, great terms, and huge upside. The huge upside factor only comes from when you can take an empty box and you can put somebody in that box that will pay you a check every single month. Now, of course, there's some capital that's going to be needed to get into the project. There's simple deposits. There's your due diligence to make sure that you get an appraisal, that you understand, you order surveys, possible environmental, these types of forecasts and these types of absorption studies and things of this nature that you'll go through during your due diligence. Obviously, if you're working with somebody qualified, they can guide you along the way. But this is simple information as far as due diligence, and we'll talk about due diligence later in another segment here for Wisdom for Wealth. But what I want to address here is that it's very easy to bring in what I call simple bridge capital, because if you're working on a project and we're buying on the actual income stream, okay, utilizing a simple formula, looking at the net. We talked about this on a couple segments back, right? You got your gross income, that means all the money that comes in on the project. After expenses, then you have the net. And the net income Looking at a 10 cap formula, all we do is times it by 10 and that'll tell us the actual value. Let me give you an example. If we're looking at a project that's pulling in 53,000, you times that by 10, what's it worth? Well, you got it right, 530,000. So that's how we justify the purchase price, and we only buy on the actual value, on what it's worth today, as is where is in its current state and in its current condition. See, this is the same format that refinance lenders apply. We're never walking into a bank and asking to get a bank loan, because if we did, then we would be following a conventional format, meaning having to put down a bunch of money to buy it. And obviously, since we're focused on projects with upside, they have vacancy, so we'd even have to put more down, like 70% down. It just doesn't work, right? See, what does work is that we justify this with the seller, the reasons why they need to carry paper if we're going to do the deal. And we can get in there, and one of my amazing opportunities that we're working with here today during this market shift is a reposition opportunity. So we'll take a project that's got a lot of vacancy, and then we'll reposition it by filling the vacancy. But you see, we buy it while it's down here and it's actual income, and it's got all this additional potential. So once we create a seller finance note for several years and we go ahead and quickly fill that, we start producing income right out of the gate. And you need passive monthly income. You've heard me say this many times before. Passive monthly income is financial security for you, for your family, so you have freedom to do what you want, and you're never going to do the day-to-day operations on these projects. And once we fill it to its highest and best use, then it's easy to go for a refinance loan, put something really, really low, a very low interest, and for that, your expenses are going to be lessened, and we are going to be able to let this thing cash flow like crazy. And that is true financial passive income for life. So I hope you enjoyed this non-conventional tactic segment here on Wisdom for Wealth. I'm Terry. Check my website out at terryhale.com. Go ahead and join my newsletter, and maybe even join in for a live webinar, and I'll show you more tactics and more strategies. Also, if I happen to have an event coming up, make sure that you get there and see me in person as well. And I look forward to talking again with you here real soon. This is Terry. Take care.